What's up, guys? This is Jimmy, also known as Jimmy1776. Today, I'm going to go over a couple things with you. One is I want to go over moving averages. So first and foremost, I am a moderator at Option Goats Trading LLC. We are a legitimate LLC out of the state of Wisconsin. A couple things I wanted to go over with our Discord. If you haven't joined it, you can find it in the link below. A couple things that I want to make sure that we go over is that we just added a new OG flow bot. What that basically is that it takes and detects different kinds of unusual activity in options, volume, and trading in the market, and comes out with either alerts, large sweeps, large block trades, analyst upgrades, breaking news bot, insider trading. We also have a scalping bot that's going to be up and live on Monday, and today is Good Friday. It's April 2nd, so that should be, what is that, 2, 3, 4? It's going to be up on the 5th on Monday. Check it out. You can always join for free, and then we have our OG Prime Premium subscription, which unlocks all of those channels that I just explained. So one of the main things today that I wanted to go over with you guys was moving averages. That's like a big thing, you know. If you're trading and looking at a chart, 5 minute, 1 minute, 1 hour, 1 day, the weekly chart, whatever it may be, one of the biggest indicators that you definitely want to have on your chart to draw up some technical analysis is definitely going to be using some moving averages. Whether you're a scalper or a day trader, a swing trader, long term, those moving averages are very useful for your own sake for a lot of different reasons. So I'm going to pull up my trading view. For those of you that don't know, I am one of the long-term investors. As of just recently, I just started scalping. So this has been, as you can see, I have my scalping indicators and my charts up right now. That's not the one that we're going to use today. I'm going to go back to my other one that is called my bread and butter. Let's get this off. Let's see. Okay, perfect. Okay, and let's get rid of some of this stuff. Let's get rid of the EMAs. That'll be just a different video. Right now, all I'm going to have on this chart is going to be volume and the 50 SMA and also the 200 SMA. This was on Cena. Actually the stock that I have up right now is a transportation logistics company because of this Suez Canal got blocked, and so I have stock in this company. But anyways, let's look at the SPY, shall we? So here's the SPY on the daily, and the blue line that you see here, that is the 50 SMA. Now, when I say 50 SMA, what that means is that whatever time increment that you're looking at, let's say it's the daily, and you're looking at the 50 SMA, what's it doing is it's taking the last 50 days of time increments that you're using. So in this case, it'd be days, and it's drawing up an average for the next line, next dot, and then it connects all the dots that you see right here, right? So, you know, during the COVID crash of 2020, when we came down, you know, this average didn't automatically come down, right? Because it's still taking in the data from 50 days ago, right? So it comes down, but not as harshly as the stock actually came down, right? During the COVID crash. This green line right here is going to be the 200 SMA. Well, let's think about that for a second. The 50 SMA will take the last 50 days. Okay. If the 200 takes the last 200 days, that's going to take in more data, right? So a drop like this would be less as harsh, and it's not going to drop as hard as the 50 SMA. If we were to pull up a 10 SMA, that would have even a steeper decline right here on the COVID crash from SPY from last year. So why is this important? You know, I've been trading equities for 12, 13 years now, and this is probably one of the most overlooked indicators that traders will use. Not if you're in OG trading though, because it seems like everybody uses the SMA, whether it be the 50, 100, 150, and then 200. I've even seen traders use the 500, which can be a little excessive in my opinion. That might be a straight line that might not even move. If we pulled up the 500 SMA, it'd be like way down here. And what could you use that for, really? So anyways, so going through here, I just want to go back in time on SPY. I want to go back even, let's go pre tech bubble, because that's probably a good starting point. So first off, the SPY, right, goes off the S&P 500. It's an index ETF. Started in, even has the date on it, back in 1993. I think QQQ started in 98 or 88. I'd have to check that, but we're looking at SPY. Okay, so it's looking right here. So one of the main things, if you're ever looking at like an IPO stock, you know, when the SPY came out, it needs 50 days of data in order to make its 50 SMA, right? See how the 200 SMA doesn't start till later. So if you're looking at like, you know, DoorDash, or trying to think of a new IPO, and you draw up the 50 SMA and the 200 SMA, those lines aren't going to be on there yet because it hasn't had that much data, right? So with the SPY, we have so much data, we have so much information that we're able to have these lines all the way going back to like 1994, right? So anyways, so here we have the SPY coming out. Now in 1995 and all the way up until the tech bubble of 2000, the SPY basically traded the 50 SMA and the 200 SMA. Now, what do I mean that it traded the 50 SMA and the 200 SMA? So if we start SPY here, we see our 50 SMA, it is riding that 50 SMA. Just like that. And right here, it bounces off that 50 SMA. Equity traders look for the 50 SMA and the 200 SMA. Institutional traders, equity traders, when they look at this stock, they're seeing that when it gets close to the 50 SMA, and in 1995, the market is a bull market, right? So if it were to get close to the 50 SMA, that would be a buy, right? If it gets close to the 200 SMA, that would be a buy. That would be a good point of entry, a good average to go into it. As you can kind of see, not saying that the 50 SMA affected this, but when it did get close to the 50 SMA, it had, what is that? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. What is that? 3 or 4 weeks of a bull run. And then in the coming weeks after that, it started bouncing off the SMA again. So let's count the bounces here. So we got 1 bounce, 2 bounce, 3, 4 bounce. This one kind of went through it and still bounced off it. 4, this one dipped below it. And when it did and it got close, it had another bull run, just like the last time when it touched the 50 SMA. I wouldn't say that's proof that the 50 SMA works in that way, but it just shows that the 50 SMA is a really good reference line to use on any kind of chart. So we're moving on here. So here comes 1996. We're still on a bull run. We dip below the 50 SMA, right? We're starting to hit the 50 SMA. It's not becoming a reference point at this point. It's becoming a line that it's starting to draw in. At this point, when it hits here, this is consolidation, right? From 1996 until the end of 1996, it's consolidating. These gap ups, gap downs. It hits the 50 SMA, bleeds through right here, and then it bounces again off the 200 SMA. People that are really wanting to get in are buying at the 200 SMA at this point in time, right? So we're going forward. It pops over the 50 SMA here, and what do you know? We're on another bull run. For right here, dips below the 50 SMA, buyers come in, they come in again, and we're trading on the 50 SMA. We bleed through the 50 SMA. Consolidates on here around the 50 SMA. When it dipped below the 200 SMA, buyers swept in. Coming through. Here's another bull run about to happen. Bounces on the 50 SMA. Now, 1998 happens. Now, I think I'd have to look back and see what event here happened. This is not the tech bubble, but it crosses under the 50 SMA, bounces on the 200. Now we're below the 200 SMA. Buyers are coming in at this point in the market in this time, right? Pops over the 50 SMA, and you can see that the 50 SMA follows suit with the stock. Now, one thing that we could consider here is that when it dipped below the 50 SMA, this bounce up, there could have been short sellers that came up short when it came up again to the 50 SMA, and let's say there was an event that caused this market to be bearish. It came up here and then bounced down again. Short sellers came in, and then the buyers came up, popped it over the 50 SMA, and then again, we're over the 200 SMA as well. That shows good signs of bullish behavior. Stays on the 50 SMA, bounce, dips below, bounce, hits its head on the 50 SMA, bounces above the 50 SMA, comes down. Now we're consolidating, right? The 50 SMA is now entangled with the market. Now we're approaching the year 2000. Here is above the 200 and the 50 SMA. Now let's zoom out a little bit here. Now we're consolidating. That whole bull run that we had for the past 4 or 5 years, excuse me, yeah, 5 years, we're going to zoom out and go forward here. And we went on a bearish run, right? Now, everybody knows back in 2000 to 2002, it was, or 2003, it was the tech bubble, right? All these stocks, Yahoo, AOL, I can't even, there were some names that you wouldn't even know today if I were to pull them up. But yeah, like Yahoo and AOL are probably really good examples of the tech bubble. Came up here. Now, if we zoom in to when everything became so flourished and overvalued and popped so highly that there was going to be an end, that all this value really wasn't true, right? It wasn't realistic in these companies, right? The value wasn't relating back to how much these companies were actually able to offer and provide, right? So what happened here when the tech bubble burst? So here we are consolidating. Here's the end of our bull run. We hit the 200 SMA. Come back, we hit our head on the 200 and the 50 SMA, right? Coming down, pop, down. Pop over the 50 SMA, hit our head on the 200 SMA. If we're above the 50 SMA, we're bullish. If we're above the 200 SMA, we're bullish. If we're above both of them, we're bullish, right? But if we're below the 200 and the 50 SMA, that is a bearish market. We would be, at that time, we would be in a bearish market. And I'll go back to the COVID crash in here in a second. But here we're just entangling with the 50 SMA, but we're under this 200 SMA bear market. We're in the bear market here, right? Comes over, hits our head again on the 200 SMA. 1, 2, 3, hits our head on the 200 SMA. We're still in the bearish market, And then lo and behold, now the buyers are coming in. Everybody that took profit up here are not writing this down. The people that bought up here are writing this down. The people that took profit up here, they're not in this. They wait for this in 2002. When the tech bubble ended, right, all this came back down. That was when the market lost almost 50% of its value, comes down here, and we repeat the process. Go on another bullish run. Okay, now what happens in 2008, 2009? Housing market. What happens to the 200 SMA? We cut below it, we bounce our head, and we are under the 200 SMA. This is a bear market. Really, really easy stuff. Really, really easy stuff. You don't have to be, I mean, not smart, but just knowing that what the 200 and the 50 SMA can tell you a lot about a stock on the daily, the 1 hour, and the 5 minute, right? So going forward, after the housing market happened, what happened during that time? People came in, bought the market, bought the shares, went into it, and they own stock, right? They're owning stock all from 2010, and we go on this crazy bullish run with a little bit of consolidation in 2015, 2016, the European crisis, and there was a platform, I can't remember the name. It was in November of this time, the European crisis, and oh man, I can't remember the platform. There was a brokerage platform that also went out during that time. Kind of the same problems that we had recently with Robinhood, kind of the same thing. Going up. We're on a bullish run. And in 2020, we have the COVID crash of 2020, right? Here we cut through, and because of COVID, stopped everything in the world, including the economy in all kinds of countries, cuts through the 50 SMA, and we're under the 200 SMA. Now, when we're under the 200 SMA, what happens? We are in a bearish market, right? We are a bearish market at that point. Popped over, and here we are. We hit 4K. We are above the 50 SMA. There are equity traders that look at this 50 SMA and 200 still in the year 2021. 26 years later, we're still looking at this 50 SMA. Popped, and then we even get a bounce, the latest bounce, and all of a sudden we're at an all-time new high. Here's the COVID. We were at 338. Now we're at 4,000. Crazy stuff. And this whole time, you can follow the 50 SMA and 200 SMA, and it can tell you whether we're being in a bullish market, bearish market, short-term, long-term. The 50 and 200 SMA are very, very useful tools. And that's on the SPY. We can look at other stocks in the next video, but this is on the SPY. Don't forget to subscribe. The link is down below, and our link to our Discord is down below as well. Just a quick view. I wanted to make sure, I went over this. Option Goats Trading right up here, our new bot that came up. We have all kinds of resources that come with it as well. But today's point of the video was the 50 and the 200 SMA on the SPY. Great example. Stay awesome out there. If you have any questions, feel free to contact us. You can contact us through our website. You can join our Discord, and then you can also email us, optiongoatsllc@gmail.com. And like I said, we are legitimate options trading Discord. Feel free to contact me. My name's Jimmy, Jumanji1776. Have a great day, and until next time, what is it, Good Friday? Happy Easter, and have a good weekend.